What would you do if a flood or wildfire or a hurricane damaged your home or rental property? Would you be able to get a tax break for those losses? For years, the rule around casualty losses have been confusing. Honestly, most people give up trying to understand them because they seem to be so unfair. But the Big Beautiful Tax Act that passed in July 2025 makes some big changes. Those are permanent changes. And today I want to explain it in plain English what those changes mean for you. I will share how the new rules actually work and what's different between your personal home versus your rental or business. And I will even tell you about some real client of mine who went through disasters with the name change, of course. Because when disaster hits, this isn't theory, this is real life. And if you know the rules ahead of time, you could save thousands of dollars at the very moment you need it most. Just a quick disclaimer before we dive in, this is for education only, it's not tax or legal advice. Every situation is different, so talk to a pro about your own tax situation. So alright, so what's the big picture, right? What changed? So before the new law, you could only deduct casualty loss if it was tied to a federal declared disaster. And even then, you have to jump through hoops. The deduction was reduced by $100 per event, and then you have to shave off another 10% of your adjusted gross income. So let's say your AGI was $100,000. You lost 20 grand in damage. So before you could even deduct anything, you had to cut off 10,100. That's brutal, right? And if your loss wasn't a federal declared disaster zone, no deduction. The Big Beautiful Tax Bill makes two things permanent. First, the casualty loss deduction for personal property only apply if there's a disaster declaration. But now it can be a federal or a state declared disaster. Number two, everything else, like say personal miscellaneous losses outside of disaster zone, those are gone for good. That kicks in starting with the 2026 tax year. So, in plain English, if it's your home or your car, you only get the deduction if there's a disaster declaration, period. But, and this is a huge but, if it's a rental property or a business, it's totally different rules. And this is where I see a lot of confusion. So let's talk about what's different between personal versus rental or business property. So here's the split. The personal use property like your house or car, you only get a deduction if the event is part of a declared disaster. And if you still have to subtract that $100 floor and the 10% of AGI, you report it on Schedule A if you itemize. For a rental or business property, no disaster declaration required, no $100 cut, no 10% AGI limitation. You still subtract insurance payment, but then you get the full loss deducted. I always remind my landlord and small business clients, don't confuse the rules for your personal home with your rental. The tax treatment is completely different. So let's talk some example from client that I have worked with. So of course we changed the name, right? So let's say for John and Maria, hurricane loss on their home. For John and Maria house were hit by a hurricane, so the damage was about $50,000. Insurance covered 30 grand, so that left 20 grand unreimbursed, and their AGI was 100K. So we have to apply the $100 reduction and then the 10% AGI floor, so that The 10% is 10,000, right? So 10,000 plus 100, that's 10,100. And then you take the 20 grand that is still not reimbursed, right? The one that they had out of pocket, minus that 10,100. So in the end, they was able to deduct about 9,900. So not the full 20 grand, but it was a real difference when they were rebuilding. So let's talk another example. Sarah have a rental property, which is a duplex that was burned in a wildfire. Her losses after insurance was about 30K. Because it was a rental property, we didn't have to worry about a 10% AGI rule or the $100 cut. So we reported directly through Form 4684 Section B, which flow into her Schedule E. So the full 30 grand was deductible against her rental income. So that saved her from paying a big tax bill in a year when she was already dealing with stress and repairs. Let's look at the third situation with the small business, the flood damage. So one of my clients run a retail shop, so the floods wiped out about 25 grand of inventory. Insurance only pay for 10 grand, so that is 15 grand unreimbursed. So that full deductible was a business expense. So here's the kicker. So this wasn't even a federal declared disaster. It didn't matter because this is business and rental losses. Don't need disaster declaration to qualify. So another big part that we need to address this is the timing, right? So now here's a strategy where most people don't know about. So if the disaster is federally declared, you can actually choose to claim the loss on the prior year return. So say a hurricane hit in 2026. You don't want to wait until you need to file 2026 taxes in 2027 to see the relief. You can amend your 2025 return, put the loss there and get the refund faster. It can be a lifesaver when you are trying to rebuild, right? An important note here, this only applies to federally declared disaster, not state-only disaster, at least for now. Let's talk some planning tips as part of this section 5 that we want to cover. First of all, you want to document everything. You want to have plenty of photos, receipts, insurance paperwork. If you don't have proof, the IRS can shut down your claim. Second, you want to check the disaster declaration, right? After a storm or a fire, the IRS usually post relief notices that tell you if your county qualifies. Third, you want to use the prior year election wisely. If you need cash fast, amending the earlier return may be better than waiting. Fourth, you can keep basic records for rental and business assets. This determines how much you can deduct. If you don't know your basis, you might lose part of the deduction. Fifth, you want to coordinate with insurance. You cannot double dip, only deduct what insurance didn't cover. Sixth, you want to be alert for state rules. Some states conform with the federal, some don't. Like say in California, for example, state disaster declaration is now more relevant than ever under the Big Beautiful Tax Act. 7, you want to check IRS relief announcement. The IRS often extend deadline for taxpayer in disaster zone, which can save you penalty and interest. Part 6, here are some bonus tips that I usually give my client. Sometimes a big casualty loss can actually push you into itemizing. So even if you usually take the standard deduction that year, you might want to itemize. For landlords, don't forget casualty losses can have offset rental income in strong years. So that smooth out your tax liability. If you are in a disaster-prone area like coastal Florida or wildfire-prone California, don't overpay estimates. So you want to keep flexibility because you might be able to deduct large losses later. For estate executors, casualty losses can reduce the taxable value of estates if damage happened before the evaluation date. So that's a planning opportunity that people sometimes miss. And lastly, prevention counts. Some home improvement can storm shutters or wildfire mitigation might qualify for credit or insurance discount. Here's the bottom line. So starting in 2026, if you taking about your personal home or car, you only get casualty losses deduction for federal or state declared disaster. And you still face the $100 per event and the 10% of AGI cut. If you are talking about a rental property or a business, totally different. You can deduct the losses even without a disaster declaration and without the hash limits. And if it's a federal disaster, you can even claim it on a prior year return to get cash back sooner. These are just tax code lines that I have seen them play out in real life with clients rebuilding after hurricane, wildfire, and floods. The takeaway, don't wait until disaster strike to understand these rules. You repair. These deductions can provide real relief when you need it most. Remember, this is for education purpose only. It's not advice. If you face a situation like this, talk to a professional who can walk through the number with you. If this helps, hit like, subscribe, and share with someone who lives in a disaster-prone area. And check the description. I have linked casualty loss tracker I built to help you document losses and insurance claim. Thanks for watching, and I will see you in the next update on the Big Beautiful Tax Act. Bye.